Buddy, welcome back to Financial Friends. Today we are going to be talking about the differences between rich and wealthy, fast money, slow money, what it is, how it applies to you, what I prefer. So let's just go ahead and dive in. If you are excited for this video, definitely go ahead and drop a like. It helps out the channel a ton, shows this video to plenty more people, and that's really what Financial Friends is all about, building that community of people that want to learn about finance. So let's get into this. I have here fast money or slow wealth, and obviously the title of the video, rich versus wealthy. So what does that mean? What is it? Well, we're going to go ahead and first we're going to define what rich and what wealthy is, what fast and slow money is, and kind of why I prefer to build slow wealth, and then how your mindset shift can help you become a better investor. So let's go ahead and start off. Rich versus wealthy, what is it? So rich is going to be on the left side here, wealthy on the right. My face is going to block rich a little bit, but there it is, rich. So the difference here is the value of money, how someone values their money. So people who want to become rich, people who want to have a lot of items and collect a lot, they don't really value their money. And as you can see here on the left side, the money is spent. They get money and they spend money, and that money is seen more as a ticket or a voucher. They have 1,000 vouchers, and they can use those 1,000 vouchers however they want to collect any type of item. And you can even see there, it kind of all builds on itself. Items over stability, meaning that they would rather collect physical items, jewelry, cars, the new video game or, system, whatever it might be. They would prefer to have those items. And I don't want to come across as condescending and rude towards any one person. This is just kind of the general stereotypes. It really is stereotyping rich and wealthy. So the money is not valued. The money is then obviously spent because it was seen as a ticket rather than a seed, and obviously preferring items over stability. When you speak of someone who is wealthy, right, their money is valued to them. Each dollar means something. It's not just some voucher. And instead, you can see it's seen as a seed, not a ticket, meaning they know that this $1 can help them earn another dollar and another dollar, and they're really planting the first seed, that first dollar, to then sprout 50 cents, which can then sprout 25 cents, and then that dollar has now turned into $5, and it's really about building your wealth and compounding your wealth over time. And obviously they can do that through investing in real estate, investing in people, in companies, in ideas, in stocks, in currencies, in cryptocurrencies. You can invest, it's not just stocks, it can be so many other things. And obviously they prefer some type of stability in their life rather than collecting a bunch of items. So they might prefer to have one vehicle but have money in the bank, have money in investments, have money growing elsewhere, rather than have 5 vehicles and not have any of that. And so you can kind of see where this is starting to lead. So we can move into collecting money in a fast manner versus building it up in a slow manner. And obviously, people who are trying to get rich, they're trying to get money fast. Generally, they don't understand their investments. They're making investments because it's the next hot stock or the next hot cryptocurrency, and they would rather take a chance on that. They would rather risk everything for a lot rather than analyze that risk and reward. And they even will hop in and out of positions. So they'll buy a stock, they'll sell the stock, they'll buy the crypto, they'll sell the crypto, trying to make money every single time, rather than understanding what they're purchasing, buying a good sound investment or good sound company or cryptocurrency, analyze that risk versus reward before making the purchase. So it's not, okay, my money has 100x potential, I'm just going to put my money in, I don't care. I hope that it can go up 100x. Instead, what they're going to do is they're going to say, all right, my money could go up 100x, but what's the risk on this? What exactly am I risking? Is it going to pay off for me for sure? Is there a 2% chance, a 3% chance? Am I not really sure? if it's going to pay off or not. So you want to take a look at that risk and reward, understand that stock or that purchase before you make it. And then they're going to buy and hold. So they're not necessarily going to get in and out of a position. And what I mean by in and out isn't buying and selling a year later. I mean buying and selling days later or even a month later, just trying to swing in and out. And there's nothing wrong with swinging in and out if that's the goal. But if you're trying to build money slowly and build wealth over time, you're going to want to buy a position and hold that position, allow it time to grow. And obviously you know or you believe that it's going to grow because you've understood it. It's a sound company and you know what the risk versus reward is. So, why do I prefer building wealth and why do I prefer to do it slowly? First thing's going to be compound interest. When you're in and out of positions, buying and selling, you're not necessarily allowing time for that investment to compound. You're just purchasing it and then trying to sell it right away. Another thing is going to be the safe and stable long-term sort of growth of your portfolio. If you're investing in safe index funds or things that you've done research on, broad market, S&P 500 style index funds, these are very long-term investments that are going to be generally stable compared to high-risk tech stocks or cryptocurrencies or other assets like that. Another thing why I prefer slow wealth is I prefer the memories over items. So I could purchase a lot of things and have new clothes, have new shoes and iPads and car and all this other stuff. But instead I would rather create a memory. So I'd rather build my wealth over time, have enough money to say take some investment or take some growth or whatever it might be to create a memory rather than as soon as I have that money, I'm instantly taking that voucher because if I was building fast, money as soon as I could, trying to become rich very quickly, I would think of it more as a voucher and I would just throw it in to some item like a car or something like that. And then it kind of keeps me calm. And there's an asterisk there because it's going to lead into my next point. Building slow wealth keeps me calm, but it allows me to sleep better at night. And this is why mindset matters. So the way that you think of accumulating money and accumulating wealth, it matters in the grand scheme of things. If you know that you have safe investments that you researched, that you understand, you're going to sleep better at night, knowing that you understand this, you know how the company makes money, you know how the asset works, and you're going to be able to utilize that to slowly build your wealth. You're also going to make sounder investments. Kind of as we've talked about this, I've mentioned risky investments versus stable, more sound companies' investments. Even if you don't necessarily think that the company, is stable, but or you believe, you have conviction, it's going to be a sounder investment for your personal self. Right? It's not necessarily going to be the perfect investment, but it's the perfect investment for you. And then the last thing is, you're probably going to pay a little bit less in taxes. Let's put it how it is. If you're buying and selling, if you are profiting, you're paying taxes every time. Versus if you're buying an asset, you're holding an asset, and then you sell it, you're going to be paying long-term capital gains if that hold period has been over a year, and obviously, you're only paying those taxes at one time. You can buy and sell Google or buy and sell, a different stock as many times as you want. But every time, if you profit from that, you're paying taxes on that gain versus paying taxes one time if you bought and held all the way through. So the last thing I'm going to touch on here is just go ahead and give this video a like for the YouTube algorithm. Go ahead and comment if you have anything to add to this. Go ahead and subscribe if you want to see more videos like this, and hit the bell to be notified every single time I post a video. I want to say thank you for watching. You can go ahead and check out all of the social media links down below. Obviously, these are the social medias here, and I hope you all have a fantastic day.